Something is breaking, and most people can't see it yet. Right now, as you're watching this, the financial system looks calm on the surface. Markets still move. Banks still operate. Salaries still come in. But beneath that calm surface, something far more dangerous is building, like pressure deep under the ocean before a tsunami hits. The signs are subtle, almost invisible if you don't know where to look. Debt levels quietly reaching historic extremes. Governments printing money at a pace that would have been unthinkable just a decade ago. Asset prices inflated beyond what real economic growth can justify. And perhaps most dangerous of all, a population that has been conditioned to believe everything is fine. But here's the truth: no one is saying loud enough financial crashes don't announce themselves. They don't send warnings. They don't give you time to prepare. Once they begin, they happen suddenly. And by the time the average person reacts, it's already too late. Think about this for a second. Every major financial collapse in history followed the same pattern: a long period of artificial stability, rising confidence, people taking on more risk because this time feels different. And then, without warning, the entire structure starts to crack. What's happening in 2026 is not random. It's the result of years of decisions, policies, and behaviors stacking on top of each other like a fragile tower. And now that tower is beginning to sway. The real danger isn't just losing money. It's losing time, losing opportunity, losing the chance to protect what you've worked for before the system resets itself. Because when the crash comes, it doesn't just take wealth, it redistributes it. Quietly, ruthlessly, from those who are unprepared to those who saw it coming. And that's why these matters. Because there are places where money doesn't just survive crashes, it grows. There are strategies that don't just protect wealth. They position you to come out stronger than before. The question is, will you wait until it's obvious, or will you move before everyone else does? Most people think financial crashes are caused by a single event, a bad policy, a market shock, a sudden panic. But that's not how collapses really work. Crashes are not explosions. They are slow burns that eventually reach a breaking point. Imagine a wooden bridge. Every day, people cross it without thinking twice. It looks strong. It feels stable. But over time, tiny cracks begin to form. The wood weakens. The structure starts to shift ever so slightly. No one notices because the changes are small, almost invisible. Then one day, under a little more pressure than usual, it collapses. That's exactly how financial systems break. Right now, the global economy is carrying more weight than it was ever designed to handle. Debt is at levels that would have once been considered catastrophic. Governments, corporations, and individuals have all become dependent on borrowing, not just to grow, but to survive. And here's the dangerous part: low interest rates have made this seem normal. For years, money has been artificially cheap. Borrowing has been encouraged, risk has been rewarded, and saving has been quietly punished. This has created a system where people are not just exposed to risk, they are completely dependent on it. Think about how many people today rely on rising asset prices just to feel financially secure. Stocks going up, real estate increasing, crypto surging. It creates the illusion of wealth. But that wealth is fragile. It's built on confidence, not fundamentals, and confidence can disappear overnight. When interest rates rise, even slightly, the entire equation changes. Suddenly, debt becomes expensive. Businesses struggle to refinance. Consumers cut back. Asset prices begin to fall, not because people want them to, but because the system can no longer support them. This is where the domino effect begins. One sector weakens, then another. Liquidity starts to dry up. Investors rush to exit at the same time. And just like that, what once felt stable turns into chaos. But here's what most people miss: crashes don't hurt everyone equally. In fact, they create massive opportunities for those who understand what's happening. Because while one group is panicking and selling at a loss, Another group is quietly positioning themselves. They are moving their money into places that are designed to withstand uncertainty. They are not reacting, they are anticipating. This is the difference between losing wealth and building it during a crisis. The average person waits for confirmation. They look for headlines. They want certainty. But by the time certainty arrives, the opportunity is already gone. The financially aware move early. They study patterns. They understand cycles. And most importantly, they respect risk. Right now, the biggest risk is not that something unexpected will happen. The biggest risk is assuming that the current system will continue functioning the way it always has. Because it won't. Every cycle ends, every system resets, and every reset creates winners and losers. The uncomfortable truth is that most people will be on the losing side, not because they are unintelligent, but because they are unprepared. They will hold on to assets that are losing value. They will trust systems that are under pressure. They will wait too long to act. And by the time they realize what's happening, the window to protect themselves will have already closed. But it doesn't have to be that way. Understanding the mechanics of a crash is the first step. Recognizing the warning signs is the second. And taking action before the crowd is what ultimately separates those who survive from those who thrive. Because in times of uncertainty, safety is not found in doing what everyone else is doing. It's found in thinking differently and acting early. There's a hidden rule in finance that almost no one talks about, yet it controls everything. Money doesn't disappear during a crash, it moves. When markets fall, when assets collapse, when panic spreads across the system, it feels like wealth is being destroyed, but in reality, it's being transferred quietly, efficiently, from one group of people to another. And the direction of that transfer is never random. It always flows away from risk and towards safety. But here's where it gets interesting. What most people consider safety is often the exact opposite during a true financial reset. Take cash, for example. It feels secure. It feels stable. You can see it. You can hold it. It doesn't fluctuate like stocks or crypto. But in a high inflation environment, cash slowly loses its value, silently, consistently. It's like holding ice in your hand. It looks solid, but it's melting the entire time. Now think about assets that are tied to real value, things that cannot be printed, manipulated, or easily diluted. These are the places where money tends to flow when confidence in the system begins to break. Because during uncertainty, people don't just look for returns, they look for protection. This is why certain assets have survived every major financial crisis in history, not because they are exciting, but because they are resilient. They don't rely on trust in institutions. They don't depend on complex systems continuing to function perfectly. They exist outside of that fragility. Another important shift happens during a crash. Liquidity becomes king. When everything is rising, liquidity doesn't seem important. You can sell almost anything quickly. Buyers are everywhere. But when fear enters the market, liquidity disappears. Suddenly, assets that once seemed valuable become difficult to sell. Prices drop sharply, not always because the asset is worthless, but because there are no buyers. This is where prepared investors have a massive advantage. They hold liquidity when others don't. They have the ability to act when everyone else is stuck. And that ability allows them to acquire valuable assets at discounted prices. But here's the psychological challenge. Doing this feels completely wrong in the moment. When fear is at its peak, buying feels dangerous, holding feels uncomfortable, and moving away from what everyone else is doing feels risky. But this is exactly why it works. Because markets are driven by human behavior, and human behavior is predictable under pressure. People panic, they follow the crowd. They make decisions based on emotion rather than logic, and those decisions create opportunities. The key is not just knowing where money moves during a crash, but understanding why. It moves towards stability, towards scarcity, toward assets that have intrinsic value rather than perceived value, and it moves toward those who are calm when others are emotional. Right now, the financial system is at a point where these shifts can happen rapidly. Technology accelerates everything. Information spreads instantly. Panic can move faster than ever before. This means the window to act is smaller, but the rewards for being early are larger. The biggest mistake you can make is assuming you'll have time to react once things start to change. You won't. By the time the average person feels the impact, the smart money has already moved. The safe havens have already started rising. The opportunities have already begun to shrink. Preparation is not about predicting the exact moment of a crash. It's about positioning yourself so that when it happens, you're not forced into bad decisions. Because in a crisis, your options become limited, unless you create those options in advance. And that's what this is really about. Not fear, not panic, but control. Control over where your money is. Control over how exposed you are. And control over whether you're reacting or leading. There's a moment in every financial cycle where reality finally catches up with illusion. It's the moment when prices stop reflecting hope and start reflecting truth. And when that moment arrives, it doesn't negotiate. For years, people have been living in a world where risk feels invisible, where markets recover quickly, where losses are temporary, where every dip is an opportunity to buy because it always comes back. But that belief is not based on natural market behavior. It's based on intervention. When systems are supported for too long, they begin to distort reality. Prices rise beyond what fundamentals justify. Weak businesses survive longer than they should, and investors become conditioned to expect safety where none actually exists. This creates a dangerous mindset because when the support is removed or even slightly reduced, the system doesn't just adjust, it overcorrects. This is where fear takes over, and fear doesn't move in a straight line. It accelerates. At first, it's subtle, a few declines. Some negative news, then uncertainty grows. People start questioning what they once believed was certain. And then, almost suddenly, confidence breaks. This is the tipping point. And once it's crossed, the psychology of the market changes completely. People stop thinking about gains and start thinking about losses. They stop asking how much they can make and start asking how much they can save. And this shift creates momentum in the opposite direction. Selling leads to more selling. Declines lead to more declines. It becomes a feedback loop. But within that chaos, there's clarity, if you know where to look. Because not everything falls the same way. Assets that were built on speculation tend to collapse the fastest. They have no foundation to support them once confidence disappears. They rely entirely on belief. And when that belief fades, there's nothing left to hold them up. On the other hand, assets with real utility, real demand, and real scarcity behave differently. They may drop initially, as everything does in a panic, but they recover faster, and in many cases they emerge stronger. This is where the concept of safe havens becomes critical. A true safe haven is not something that simply holds value. It's something that attracts value when everything else is losing it. It becomes a destination, a place where capital flows during uncertainty. And these destinations are not random. They are consistent across cycles because they are rooted in fundamental human behavior. When people are uncertain, they seek stability. When they are fearful, they seek security. And when they lose trust in systems, they seek assets that exist outside of those systems. This is why preparation is not just about diversification. It's about intentional positioning. It's about understanding which assets are likely to benefit from instability, not just survive it. And it's about recognizing that safety is not static. It changes depending on the environment. What feels safe during growth can become dangerous during contraction, and what feels boring during stability can become powerful during chaos. The challenge is that most people only realize this after the fact. They chase performance during good times and protection during bad times. They react instead of anticipate, and this cycle keeps them one step behind. Breaking that cycle requires a shift in thinking. It requires seeing the system not as permanent, but as cyclical, not as stable, but as dynamic. And once you see it that way, everything changes. Because you stop asking, what is working right now? And you start asking, what will still work when everything else stops? That question is the difference between vulnerability and resilience, between reacting and being ready. If you strip away all the noise, all the headlines, all the opinions, financial survival comes down to one simple principle: where your money sits determines your future. Not how hard you work, not how much you earn, but where you place what you've already built. Because in times of stability, almost any strategy can work. Growth hides mistakes, rising markets cover poor decisions, and momentum creates the illusion of skill. But during a financial reset, the truth is revealed. Every weakness becomes visible. Every bad allocation gets exposed, and every decision you delayed suddenly matters. This is why the concept of shifting into safe havens is not just a strategy, it's a mindset. It's about stepping back and asking yourself a difficult question. If the system changes tomorrow, will my money still be protected? Or is it dependent on everything continuing exactly as it is? Because that dependency is where the real risk lies. Most people don't realize how exposed they are. Their income depends on the economy staying strong. Their investments depend on markets continuing to rise. Their savings depend on currency maintaining its value. It's a chain of assumptions. And if even one link breaks, the entire structure becomes unstable. Shifting into safer positions is not about abandoning growth. It's about creating a foundation that can withstand uncertainty. It's about balance, holding assets that are not all tied to the same outcome, maintaining liquidity so you can act when opportunities arise, and reducing exposure to systems that are showing signs of stress. But here's the part that requires courage. Making these shifts often feels uncomfortable. It means going against the crowd. It means stepping away from what is popular. It means accepting slower gains in exchange for greater security. And in a world that constantly rewards speed and growth, that can feel like a step backward. But it's not. It's a strategic pause, a repositioning, a way of ensuring that when the next phase begins, you're not starting from zero. Because crashes don't just destroy, they reset. They clear out excess, they remove inefficiencies, and they create a new starting point. For those who are prepared, that starting point is not a loss, it's an opportunity. An opportunity to acquire assets at lower prices, to enter markets with less competition, to build wealth in a system that has been recalibrated. But none of that is possible if you're caught on the wrong side of the shift. If your capital is locked in declining assets, if your options are limited, if your decisions are driven by fear rather than strategy, this is why timing matters. But positioning matters more. You don't need to predict the exact moment of a crash to benefit from it. You just need to ensure that when it happens, you're not vulnerable, that you have flexibility, that you have clarity, and that you have the confidence to act when others hesitate. Because in the end, financial success is not about avoiding every risk. It's about managing risk in a way that keeps you in the game, that allows you to adapt, and that positions you not just to survive uncertainty, but to use it. The window to prepare is always open, until it's not. And once it closes, the only thing left is reaction. The question is simple. Will you move while you still have control, or will you wait until the system forces you to? Ending call to action. Concise, motivating, linked to financial growth. If you want to stay ahead of the next financial shift and learn how to protect and grow your wealth, no matter what happens, subscribe now and turn on notifications, because the difference between reacting late and acting early could define your financial future.